Hey, what's up, my friend? So, you're watching this video because you have a small trading account and you're struggling to grow it. Or perhaps, right, you have blown up multiple trading accounts while attempting to grow your account bigger. Or maybe the profits that you're making on your trading account is so small and insignificant that you're wondering, man, Rayner, is this all even worth it? Now, if any of those sounds familiar to you, then you're in the right place, because in today's video, I'll share with you how you can grow your trading account to 6 figures, 7 figures and beyond, even if you have a small starting capital. But just to be clear, if you have a $500 account and you're looking to turn it to 6 figures the next month, then please stop watching, I can't help you. But if you want to learn the strategies and techniques that professional traders use to grow their account to 6 figures, 7 figures and beyond in a safe and consistent manner, then today's video is for you. Sounds good? Then let's get started. Okay, so if you have a small account, then you must exploit the 9th wonder of the world. But first, let's take a step back. What is the 9th wonder of the world? Or rather, what is the 8th wonder of the world? So the 8th wonder of the world is what Albert Einstein has said, right? Compound interest, right? It's the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. From Albert Einstein. So taking this a step further, right? This is what I call the 9th wonder of the world. This is something that I term it on my own, right? So let me walk you through an example. So let's say you have a trading account. You start off with $1,000. You intend to grow the account for the next 30 years at an average annual return of about 20% a year. So your strategy does an average of about 20% a year. So after 30 years, right, your account will be worth about $237,000. And as you know, right now inflation is pretty darn high, right? So taking into account inflation, this isn't really a lot of money anymore. So what else can you do? Of course, you can do a few things. Number one, you increase the duration, right, of your compounding effect. Maybe instead of compounding for the next 30 years, you compound for the next 200 years. Well, that's all fine, right? Problem is you have to spend that money in heaven while you sing Alleluia, right? So that option clearly not too feasible. Now, what about increasing your annual return each year? Maybe instead of aiming for a 20% annual return, you aim for 100%. That's possible, but problem is if you were to do that, right, you will likely have to take on higher risk to earn that higher returns, and you're likely risk, right, blowing up your entire trading account. And again, something that we don't want. So what is left, right, for us is actually this, right, this field called annual addition. What if we add in an extra $1,000 to our account each year? Each year, right, not each month. So each month you save like, an extra $80 or $90, or so each year you can fund an extra $1,000 to your account. How much of an impact would that make to your account? So let's find out. So you can see over here, we start off with $1,000, add in an extra $1,000 each year, grow for the next 30 years at this annual return of 20%. And after 30 years, your account is worth, get ready for it, right, $1.6 million. Can you see how powerful this is? And by the way, you didn't make much changes. You didn't use a different strategy. You didn't compound your returns for a longer period of time. You didn't increase the risk, right, that you're taking to trade your account. The only thing that you did is to add in an extra $1,000 a year, and you have more than 7x your initial return. So this concept is very powerful, right, for regardless of the size of your account that you're trading right now, whether small, medium, or large. So to sum it up, right, to exploit the 9th wonder of the world, you want to regularly add funds to your account so you can compound your returns faster. Okay, now I want to share with you something important. So what you're seeing right now is a Chinese bamboo tree. So to grow a Chinese bamboo tree, you must, have put in the seeds in the ground, water it, fertilize it, give it sunlight, right, to grow. So imagine this, you do this for a full 1 year. Guess how much your bamboo tree has grown? Well, nothing, right? It's still flat in the ground. Nothing comes up from the ground after 1 year of, religiously, planting the seeds, putting water, sunlight, etc. So you do this again for the 2nd year. After all, it's a good physical workout. And in the 2nd year, again, nothing comes up from the ground. By then, this habit of yours is really inculcated into you. So you continue doing this for year 3 and year 4. And still, nothing comes out of the ground after 4 grueling years of watering your bamboo seeds in the ground. At this point, you're probably thinking, man, did the seeds die? What the beep is going on? Right? You're probably, having a lot of doubts in yourself. Now, the 5th year comes along. And out of the sudden, within 6 weeks, right, the bamboo tree grows up 30 meters, which is about 80 feet, in 6 weeks. So now the question is this: the bamboo tree grew 80 feet in 6 weeks. Or was the little tree actually growing underground to develop a root system, to build a strong foundation to support its potential, right, so it can grow outwards, right, in the 5th year and beyond? I think you got the answer. And the reason why I'm sharing this story with you is because it's the same for trading. In your early years, right, it's meant for you to build your foundation, to make all the mistakes that you can make, to instill that discipline, to find the trading strategy that works for you. So this way, once you have a strong foundation, you can then reap the rewards for the later years to come. Does this make sense? If it does, smash the thumbs up button on this video and hit subscribe. Okay, the next tip that I have for you is to think in terms of percentages. So imagine this. Imagine you have a $1,000 trading account and you grow it by 20% for the year. That is about $200 a year. Now I know many of you will be thinking, man, Rayner, so much work for just $200 a year. I can't even buy milk powder for my kids, Rayner. Man, Rayner, I work at McDonald's and I'll make even more money. And guess what? You're absolutely right? Working at McDonald's will probably, earn you more than $200 a year. But here's the thing. Working at McDonald's is not scalable. What do I mean by that? So trading, right? Let's say now you grow your account size to $10,000. And 20% return on a $10,000 account, that would be worth about $2,000 of profits in a given year. And what if you take things even further? Let's say your account size is now $1 million. A 20% return on $1 million is worth $200,000 of profits in a year. Do you know how many Happy Meals you can buy with $200,000? So here's the thing, okay? I want you to think in terms of percentage, right? Not the dollars, right? Because it gives you a more objective view of your performance. Plus, it makes you feel better, especially when you're dealing with a small trading account. Sounds good? Now, the next thing I want you to do is to honor your stop loss. And this is important because on a small trading account, right, your losses in terms of dollar can really seem insignificant. So for example, let's say you have a $500 trading account and you risk 2% on each trade. So theoretically, right, each loss that you incur will not cost you more than $10. So imagine, right, as the price reaches your stop loss level and you're down $10 right now, you might think to yourself, that's a small amount of money, I can afford to lose it, right? So you hold on to your losses, or even worse, you average into your losses. So the $10 loss now becomes a $20 loss. And you continue holding on to your losses. Now the $20 loss becomes a $50 loss. At this point in time, right, you average even further into your losses. And the market continues to go against you. Now, that $50 loss has snowballed into a $300 loss. And before you know it, you've now lost 60% of your account on just one single trade. And it's all because you refuse to honor your stop loss. You refuse to cut your loss when it was very insignificant at the start. So here's the thing, right? If your losses, right, get too big, right, you might reach a point, right, of no return. This is what we call the risk of ruin. So let me explain. So if you look at this table over here, right, if you lose 10% of your account, you need a return of about 11.11%, right, to get back to break even. If you lose 50% of your account, you need a return of 100% to get back to break even. And of course, when you reach, a drawdown of 70%, 80%, or 90%, this is where the returns get really ridiculous, right? Just to get back to break even. And it's what we call the risk of ruin. It's pretty much the point of no return. So if you want to avoid the risk of ruin, you must honor your stop loss. Yes, I know the loss can seem really small, really insignificant, but you still must honor it. Your good habits start now when your account is small, right? Not later on when you're trading a 6-figure or 7-figure account, when you make mistakes like this, it's going to cost you a lot more. Okay, moving on. Consistent action gives you consistent results. I know this sounds a little bit, vague. So let me give you an example so you understand how this works. So imagine your trades, right? The outcome of the next few trades is something like this. Lose, 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 and then win, 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 win. Okay? So let's say you're trading with a proven trading system, right? And you are following your rules. And as you can see, right, as you follow your trading rules, your first 3 trades are losers. Okay, so you're feeling really raw, man. 3 trading loss in a row. This sucks. Trading is tough. So when the 4th trade comes, right, over here, you decide to skip it because of the recent losses that you had. You think, oh man, this is likely to be a losing trade as well. Let me skip the trade. Well, guess what? It turns out to be a winner over here. Then your fifth trade comes along. Again, you decide to skip the trade because of the recent losses that you have encountered, right? The pain is still very raw. So let me skip the trade again. And once again, turns out to be a winner over here.
What? What the fuck?
So then comes the next trading opportunity. And now you're stuck, right? You're thinking, man, should I follow my trading rules or skip the trade? But because the recent losses are still too much to bear, you decided to, let your emotions take over and skip the trade. And then guess what? Another winning trade that you missed.
No! God, please, no! No!
So at this point, you can't take it anymore. Okay? So you decided to follow your trading strategy because if not, right, you might miss out on further gain. So you decided to take the next trade that comes along. And finally, you caught this winner over here. However, if you look back, your winner is not enough to cover your losses, the 3 losses that you had earlier. And if you look at this from a big picture standpoint, if you had followed your rules, you would have actually, come up ahead, come up profitable because you had actually 4 winners over here compared to your earlier losses that you had earlier. So 4 winners against 3 losers, you would have, made money, right, over this series of trades. But because you didn't follow your rules, because of emotions, because your actions were not consistent, that's why you didn't get consistent results. So I hope through this example, you can see that if you want to be a consistently profitable trader, you must have a consistent set of actions. Whenever the setup presents itself, you gotta take it. You cannot second guess yourself. Oh man, I think it's gonna be a loser. Let me skip this trade, yada yada. Because guess what? If you end up skipping trades, your results will not be consistent because your actions are not consistent. By now, you can see how important it is, right, to be consistent with your action. But that's not all, because you must also have a trading strategy that works. If not, right, imagine this. You are consistent with your action, but you are using a trading strategy that doesn't work. Guess what happens? Well, your results will still be consistent, but you'll be consistently losing. Yeah? So it's important, right, to have a trading strategy that works. And if you want to learn of such a trading strategy, then I'd like to invite you to my upcoming webinar called Stock Trading Secrets, where I'll share with you a proven trading strategy that has generated 3,225% over the last 22 years. Plus, I'll share with you how it's possible, right, for you to generate profits almost every year from the markets, right, regardless of whether it's a bull market, a bear market, or even during a recession, right? So join me at my next upcoming webinar. I'll put the link below this video. So sign up for it. It's free, and I will talk to you soon.